years old.
So, over to Ray.
The one thing that I'm going to say this evening that I'm certain about, it's absolute fact, is that I was attending PDAC before Sonia was born. I know that to be absolutely certain. I'd like to begin this discussion today, first of all, of course, thanking you all for sacrificing your Sunday and coming out here to hear what we have to say about mining stocks, of course. But also to thank Peter Boitos, who's done wonderful work for the mining industry, for PDAC, and who has been responsible for the Newsletter Forum every year for about 10, 12 years. Thank you, Peter, and thank you for the volunteers. It's been great. I have lots of things to talk about today. That's the bad news. The good news is that I'm going to constrain myself because I understand that I'm all that stands between you and beer. And standing between you and beer at PDAC is not a good thing for an old man to do who would like to become older. So I'm going to, in fact, constrain my remarks and then later, hopefully, join you. I'd like to begin with some discussion of some of the major trends. You guys have probably been beaten to death with global macro today. But I'm going to talk to you about some of the major trends that I see that have shaped my own investment decisions for the coming year. Because I'm also going to tell you about something that I can talk about with some certainty, which is what I'm doing with my own money and why. And it's important that you understand the sort of framework that I'm making these investments in. So let's get to that. The major trends that I see, well, I see many major trends, but the ones that are immediately important to the two prime investment motivations in the room, which are, of course, greed and fear, are as follows. In the first instance, supply destruction. This is a theme I talked about last year. For those of you who weren't here or more likely don't remember, supply destruction is a circumstance where commodity prices stay low enough over a long enough period of time that the industry capitalizes, or pardon me, cannibalizes its own capital. That sustaining capital investments aren't made, that new investments aren't made, and as a consequence of that, the industry and in fact humanity lives on deposits that are long of tooth. Supply destruction is the most bullish of all phenomenon, because when you balance supply and demand by destroying supply, and the price begins to move up as a consequence of market tightness, the industry can't increase supply in the near term to meet pricing signals because the industry is capital intensive and it takes a very long period of time. If the copper price, for some reason in July, were to move from $2.75 a pound to $4 a pound, the near-term price response, pardon me, the near-term supply response in the copper business wouldn't exist because it takes years, sometimes decades. There's a very good copper explorer in front of me shaking his head. The fact that he has no hair testifies to the long lead times that are required to find a major copper deposit. Couldn't resist. You'll have your chance at me later. But the truth is, in fact, that supply responses can take 5 years or 6 years or 7 years. One of the reasons why commodity booms are so exaggerated relative to price moves and other circumstances. And we have wonderful, wonderful, wonderful circumstances of supply destruction around us today. I remember several years ago at the podium at PDAC, people talking to me about the oil industry with the oil price stuck at $30. And I was really bullish. The International Energy Agency was saying it took $60 a barrel fully loaded to produce a barrel of oil, including the cost of capital. So you make the stuff for 60 and you sell it for 30. You lose $30 a barrel. You do it 100 million times a day. Eventually it gets boring. And the circumstance of that, of course, is that without the sustaining capital investment, the supply dries up. When the supply dries up, the price goes up. That's what happens. It happens commodity across commodity across commodity. And if you look at the supply side in the industrial material space, conventional energy, all those places, the future looks truly spectacular. That's the good news. Sadly, there's some bad news that follows too. Don't anyone confuse me for an economist. I'm a loan shark, really. But the other side of the supply-demand equation is, of course, demand. And I'm not an economist, but I listened with some interest to John Kaiser's description of what a glowing future we face. All that makes some sense to me, but the thing that makes the most sense to me personally is that we're 9 years into an economic recovery. A tepid recovery to be sure, but from my experience investing over 40 years, I sort of believe that a 9-year recovery may begin to be sort of long of tooth. I would also suggest to you that this recovery was driven at least partially by artificially low interest rates, by liquidity. I'm tempted to say that some of the market confidence that we face today is a consequence of people confusing liquidity, that is cash in the system, for solvency, the ability to service our debts. And liquidity and solvency, I can assure you as a lender, are not the same thing. So at the same time that I see problems on the supply side of the equation, which ironically would benefit the industry, I see potential problems on the demand side of the industry too, particularly if interest rates rise. What's my conclusion out of this? I don't have one. I honestly don't have one. John said it well. Pick great deposits, hang on for dear life. On the gold side, however, I think the gold macro is decidedly more appealing. And I think for the reasons that John covered, plus a few. It was interesting when he talks about the impact on the financial services. Well, let's start somewhere else. Let's start with the fact, and I talked about this last year, these are big, big, big numbers, and you're gonna stare back at me with sort of glazed eyes because the numbers are so big. US, I won't pick on Canada until later, but in the US, our on-balance sheet federal liabilities are $22 trillion. Just for fun, I want you to write that down. It's 22 with 12 zeros, except each of these zeros has a meaning if you're a taxpayer. That's the on-balance sheet liabilities, but the off-balance sheet liabilities, and by the way, this number doesn't come from an old cranky gold bug. The U.S. Congressional Budget Office estimates the net present value of unfunded liabilities, federal liabilities in the United States, is between 120 and 140 trillion dollars. These are debts that aren't formal debts. In fact, if you want to know, particularly the young people in the room, if you want to know what an unfunded liability is, I'm 66. As a young person, I'm your worst enemy. I'm going to get Social Security, I'm going to get Medicare, I'm going to get Medicaid. For 40 years, I've been making promises to myself, and y'all getting stuck with the bill. And it really, 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 truly isn't pleasant. So what John Kaiser said is that we have a decision to make. The young people have a decision to make. The right thing to say would be to say, you know, you old guys, you made all these promises, you paid for them. You know, I'm out. I'm going to take a pass. That would be an interesting political discussion, I think. And one outcome of that discussion, I think, while it might not be good for some people of my age, it would be extraordinarily good for the gold price. But I guess what I'm trying to say, and I could deal with Canada later, but in the United States, I think our choice over time is an honest default, where we say, yes, we made a promise, but we're not going to keep them, or a dishonest default, which is that we inflate away or otherwise debase the net present value of the obligation. Good for gold, I think, in both circumstances. Internationalizing this discussion, a couple of years ago, and I talked about this last year too, I talked to a very large Asian client of Sprott's, state-controlled, talking about their holdings of US treasuries. And I said, you know, from my point of view as an American, I'm delighted about the fact that you guys send us all kinds of cool stuff, cars, computers, machine tools, stuff like that. We send you back pieces of paper with dreams painted on them. I mean, for me, from my point of view, it's just a hell of a swap, you know. I'm curious about how it feels from your point of view, you know, talking about the US 10-year Treasury. I said, you know, when I look at our balance sheet, look at our income statement, the US 10-year Treasury feels, well, it feels like a little bit of a lie to me. This is a country that has a lot of treasuries. And he looked at me, I'll never forget this as long as I live. He said, Mr. Rule, what you say is ultimately true, but yours is a deep and liquid lie, unlike all of the other lies that we're told. And I said, do you trust us? And he said, of course not. It's just that we trust you so much more than we trust each other. And the reason I tell you this, other than to make you laugh late in the day, is to talk about the fact that these dislocations, intergenerational dislocations and American dislocations, are really truly global dislocations. I'm not one of these guys who says that gold is going to win the war against the US dollar. I'm not. I just think gold is going to lose less badly. Here's a wonderful statistic for you. Precious metals and precious metals securities represent between 1/3 and 1/2 of 1% of all investable assets in the United States. You know, we probably rival ceiling fans or something like that. In 1981, precious metals and precious metals related assets had an 8.5% market share of US investable assets. Am I suggesting that the market share of precious metals and precious metal securities is going to go from 0.5% to 8%? Of course not. But the 3-decade median and mean are between 1.5% and 2%. I believe in reversion to mean, which means that I believe that the market share of gold and precious metal securities is going to go from, on the high side, 0.5% to between 1.5% and 2%. In other words, demand for this asset class will, over the next few years, in my opinion, quadruple in a crippled economy that's still 1/4 of the world's investable assets. Why? Well, for 2 reasons. We talked, one, about the fact that the gold price, in one way, shape, or form, I believe, represents more than anything else a vote of confidence or lack of confidence in the strength of the US dollar as represented by the US 10-year Treasury. And my own suspicion is that the US 10-year Treasury has a yield that doesn't conform to the risk. I think the market is confusing liquidity with solvency. Let's assume I'm wrong. What are the upsides and what are the downsides? The US 10-year Treasury has been in a bull market since the end of 92 and change. I would suggest to you that that bull market is either over or closer to the end than to the beginning. And if you believe that gold trades contra to the faith in the purchasing power as expressed by the market for US 10-year Treasuries, then I would submit to you that the gold bull market is closer to the beginning than to the end. So I feel better as a commodity about gold than I do anything else, with the possible exception of uranium, but that's such a small asset class. We can talk about that in a separate circumstance. So that's the sort of broad framework I want to talk about. What's changing that I want to take advantage of right now? I'm talking about what I'm going to do with my money this year. And the coolest change, I sound like a kid, huh? Cool. Let's rephrase that. The nicest change, the most interesting change, the most lucrative change that I see in the gold equities market. Everybody's talking about it. We talked about the podium last year. Mergers and acquisitions. This is all good. Everything about it is good. Unless maybe you are an officer or director of a company that has taken over and you become made redundant, but that's a good thing too. Good in every regard. The biggest problem of many problems that the gold mining industry has is too much G&A relative to AUM. We have too many management teams. By the way, the same thing is true in investment management. So I'll paint myself with my own brush. And at 66, I'm eager to be made redundant. At any rate, we have too much G&A. Bristow has said that the prospective merger, in his take under, would free up at least $350 million in surplus G&A a year. Think about that. You merge these two companies, you make $1 million a day. Now, $1 million a day would be one of the better mines in their stable. I would suggest it would be the best mine in their stable because it has no sustaining capital expense. It isn't commodity price sensitive and it doesn't deplete. So with this one simple act, you put in place the best mine in the stable, except for one that doesn't have to go away over 50 years. Let's say that the surviving company traded at 10 times EBIT. You add $350 million, your enterprise value goes up by $3.5 billion, which means your cost of capital goes down by a sum that is dividing the shares outstanding by $3.5 billion. Wonderful, wonderful thing. Amalgamation has happened across all kinds of other industries. The only reason it hasn't happened in the gold mining industry is because the multiples of NAV that investors were willing to pay for gold mining companies meant that the management teams could keep their fat selves employed for decades after their sell-by date. And that's coming to a screeching halt, which is wonderful. Larger companies, not just larger companies, the smaller companies, the more assets we place under smaller management teams, the lower the general and administrative burden relative to assets under management and relative to EBIT. All good. Second thing is larger companies are more liquid. Larger, more liquid companies attract more capital. They have higher share prices. They have a lower cost of capital. Gold mining is a capital-intensive business. Lower cost of capital, capital-intensive business, good. Okay? Lower G&A, good. Lower cost of capital, good. Coming down the value chain a little bit, capital efficiency. It shouldn't be, but on occasion, management teams that only have one project in their stable think that's a pretty good project. Because if they don't like it, they're working at Home Depot. Companies that have a greater range of assets to employ capital against make better capital allocation decisions. That's the way it works. Amalgamation means that you have better opportunities to employ capital, you make better capital allocation decisions with a lower cost of capital and a lower G&A. These things are all obvious. Liquidity, G&A, capital efficiency. They're all obvious, and they're going to have a positive impact on the business in the next year and a half or 2 years. The thing that attracts me personally more is a little bit more subtle. When, and I shouldn't say when, if, let's assume, just for fun, that Newmont and Barrick were able to merge. By the way, I don't care who wins personally, but let's just assume they were able to merge. And let's assume that Bristow's investment criteria held 15% internal rate of return at $1,000 gold. Major tier 1 projects. What that means is that there's a bunch of inventory inside Newmont, inside Goldcorp, inside Barrick, inside Randgold that comes on the market. We think about $14 billion in redundant properties comes on the market in the next 2 years. This is interesting in many regards. It's interesting because it lowers the ultimate acquisition cost that a major pays for another major. In other words, they lower their merger costs by lowering the G&A and by selling redundant assets and by laying off people. So it's good at that level. It's good at the transactional level. But it's good for the mining business too. Because assets that weren't germane to Newmont could be extraordinarily germane to an Atlantic Gold, an Equinox, a smaller company, even to a Kinross. A project that wasn't developed for the benefit of the industry because it wasn't germane to the company that owned it might become extremely germane to another company. We've seen this in past cycles. How many people here were Lumina Copper shareholders? Really? Yeah, I know you were. Think about that. Ross Beatty, at the bottom of the cycle, when the copper industry was merging, bought, if my memory serves me well, 7 copper projects from majors. Projects that didn't fit the majors. If my memory serves me, he spent about $30 million buying all 7. He spent about $80 million on them, and he sold them for $1.6 billion or $1.7 billion. The opportunities for wealth creation using the projects that didn't matter to the majors, but matter to smaller companies who can focus on them and add specific value is very high. And the value to the juniors by taking the intellectual capital from the majors that has been made redundant in the merger matters too. You'll have a circumstance where a junior working in Nevada all of a sudden has the opportunity to acquire for free from Newmont 3 or 4 people who have 30 years each experience in Nevada. In other words, you buy 120 years of intellectual capital that got their, if you will, PhDs from the School of Hard Knocks, paid for by Newmont. Talent that right now the junior doesn't have access to, but will have access to, and with access to exploration inventory that they never would have got had it not been made redundant. This is a spectacular circumstance for the junior industry. It will take the junior industry a while to own up to it because the existing management teams can't afford what they're doing now, never mind to grow. But the opportunities available to the best and the best of the mining business, the junior mining business, as a consequence of this, are, from my point of view, extremely attractive. So I've taken you through the setup. You're still wondering, so listen, Rick, you said you were going to tell us what you were doing with your own money. Sadly, I don't have time for that. I just have to send you one. actually, Sprott wrote the check for this conference, so I get to write this part of the conference, so I get to run on a little bit if I want to. I know that I'll get some tolerance from the podium. Sonia works for me, so she can't kick me off. There are three ways to play this that are attractive to me. The first is fairly obvious, mergers and acquisitions. And I was really aggressive about this 7 months ago, but the two big mergers that we've seen has made the sense that big companies taking over small companies are less urgent because big companies are taking over big companies. And the assets that are being made redundant out of the majors will depress demand for smaller companies. That notwithstanding, you're going to see lateral mergers, and you will see a circumstance in the occasion where a small company makes a big discovery, where there are mergers top to bottom and side to side. We put together a list of, I think it was 52 M&A targets 6 months ago, which gave us a wonderful list to work with. Sadly, further due diligence took 52 down to 7, but I have been actively taking advantage of that 7. This is going to be a two-way street, though. There will be circumstances now where the Sandstorms, the Ross Beatties, the Oxygen Capitals of the world see assets that are being spun off out of majors, put together the capital and grow companies. So it isn't just going to be acquisitions of smaller companies by bigger companies. It's going to be the building of smaller companies out of the excesses of big companies. And there's going to be a lot of money made at this. A lot of money made at this over the next 2 years. The second idea is a little stranger, but I like it just as much, maybe more, because everybody disagrees with me. The royalty and streaming space, people say, is overpriced and can't grow anymore. I suggest to you that that's A, wrong, and B, wrong. B, it is true that the royalty and streaming space sells at a premium to their operating peers, but the royalty and streaming guys are operating on 65 or 70% profit margins, while the profit margin for the operating sector as a whole is negative. One needs to decide how much money is appropriate to pay for losing money, rather than paying to make money. And the truth is that the streaming and royalty companies have an advantage in the sense that they have no sustaining capital expenditures. And it is also true that owning a stream or a royalty on a very large property, or in fact any interest in very large property, is a wonderful thing. In my experience, and I'm sure some of you can corroborate this, big projects almost always yield good surprises. And small projects, in my experience, almost always yield bad surprises. And the big projects that are already in the Franco-Nevadas, the Wheatons, the Royal Golds, I suspect will continue to yield good surprises, just as they have in the past 3 years, where exploration has increased the per share reserves even after 3 years of production at the big three royalty and streaming companies. Now, the second assertion with regards to growth. Most people don't like to admit this in the mining industry, but the cost of capital for a non-investment grade company to build a mine is about 15%. It's interesting when you do valuations, by the way, that these junior miners ask you to do 8% net present value when the cost of capital is 15. I would suggest to you that that delta, negative delta between the valuation number and the cost of capital is responsible for most of the underperformance that you see, but that's a different item. Increasingly, with capital less and less available to non-investment grade issuers, the market share of streaming in mine finance will only grow. What's really changed is that streaming is also going to be an extremely important component in financing mergers and acquisitions. If you have, by our count, $14 billion in dispositions that are already on the books, and that number is almost certain to grow, the share of royalty and streamings in this 14, soon to be $20 billion in transactions is probably $5 or $6 billion, even before mine finance. The other great truth is that in businesses like the copper business, EBIT in a copper business is valued at 5 or 6 times EBIT, while the gold or silver byproduct stream from a copper mine is valued at 13 or 14 times EBIT if you are Wheaton or Franco-Nevada. Ergo, The biggest base metals mining companies in the world can substantially lower their cost of capital by selling the precious metal stream from their copper production to a Wheaton or a Franco. This is a weird circumstance where Wheaton or Franco can do an accretive transaction. In other words, they can increase their return on capital employed at the same time that the vendor can lower their cost of capital. A circumstance where billions of dollars can be employed to the benefit of both parties is going to occur. So I'm buying royalty and streaming companies really from the largest to the smallest. I'm buying the whole waterfront. I'm buying them in the oil and gas business too. That has been a very challenging idea. The next one's going to challenge you a lot. My assertion is that the mining industry has underinvested and misinvested in exploration since the middle part of the decade of the 90s. Underinvested, I don't think anybody quarrels with me about, but misinvested too. The truth was, and is in places like Australia, that the value creation stream was supposed to be rocks to money. In other words, you made a discovery, you mined it, and you got paid. The value creation mechanism in the United States got perverted by the bull market in the early part of the last decade. The value creation stream now is rocks to stocks and stocks to money. Too much money in exploration was spent attempting to jitney a stock from 25 cents to 70 cents without anywhere near as much interest being paid in discovery as should be paid. Probably 100 times in the last 10 years, I've watched somebody dust off a project that's failed in the last 3 booms, drill a confirmation hole next to the only hole that ever succeeded in the last 30 years, and call it exploration. That isn't what it is. It's legal, but what it really is fraud, which is to suggest that the junior industry has been guilty of malinvestment for billions of dollars. And the major mining companies have simply decided that exploration was a marginal expense. It was nowhere near as important as, directors' emoluments, first-class hotels, conferences, stuff like that. The consequence of which is, and they'll acknowledge this, their exploration cupboards are bare. Not only are their exploration cupboards bare, but their exploration departments are understaffed. This, I think, leads to a surprising boom in exploration in the next 5 years. Those of you who know me know I'm no real fan of sole risk exploration. In the junior side, the public company cost $1.5 million a year, put on top of $2 or $3 million a year project cost, means that juniors are an extremely inefficient way to conduct sole risk exploration. Prospect generation, however, a research and development business really more than anything else, an intellectual capital business, is a superb way to participate in exploration. Boring? Certainly. In a high-risk business like mining, I would suggest that boring is high praise indeed. So let me give you one final stat in defense of exploration from my point of view. When I was in UBC, I learned that 1 in 3,000 mineralized anomalies becomes a mine. So the value proposition held up to you by Bay Street or House Street is to take a 1 in 3,000 chance of 10 to 1 return. I mean, it makes the BC lottery look like a hell of a deal. It's suicidal. Now, people say that you can lower your odds in various ways, and in fact you can. If you hang around with high-quality people, you lower the odds a lot. If you wait until you have the third dimension, that is a drill hole, the odds improve all the way to 1 in 100. Yes, better than 1 in 3,000, but it's still a really, really, really shitty use of funds. It's an insanely stupid use of funds. By contrast, with prospect generators, and I'm going to get the numbers wrong, but I've invested in 65 or 66 over 30 years. I've participated in 21 economic successes and 20 takeovers. So juxtapose those two numbers, 1 in 100 or 22 out of 65. A young smart intern, this isn't my number, but a young smart intern who worked for us said that the returns in my portfolio from prospect generation reflected a 3rd standard deviation of outperformance relative to the mean. That kind of math is compelling. So I would suggest to you that I wouldn't suggest anything to you on second thought. What I'm doing in the context of the factors that I've laid out with my own money is three things. I'm playing the M&A business, but I'm playing it both ways. I am looking for companies that are likely to be taken over at the same time that I'm looking for teams to back to take over assets from majors. With my less hardworking money, I'm buying the royalty and the streamers. I think the wind is at their back, and I think they're superior businesses. And with my bad money, I make fun of speculators, but all the money I now invest, I made speculating. With my mad money, I'm buying the prospect generators because I think the next 5 years is going to be really much stronger than people think in exploration. And statistically, the only sane way to play exploration, the explorers in the audience are going to hate this, but the only sane way for an investor to play exploration is through prospect generation. Ladies and gentlemen, thank you for your time and attention. I don't know if I have time for a question or not. Again, let's allow the audience to segregate. Those who want beer now should leave, and those who have a question, I'm happy to entertain a couple of them. Looks like beer is winning. Sir.
Rick, earlier in your comments you touched on uranium.
Did I? I thought I would over time. I think the uranium bull market is inevitable, but I'm not sure it's imminent. Very low liquefied natural gas prices, seaborne liquefied natural gas prices, have meant that the Japanese need to restart their uranium fleet is less extreme than I would have hoped for. It's wonderful if you happen to be Japanese, I'm not. And I think that in the near term, the uranium price is determined by the pace of Japanese restarts. 4 or 5 years from now, new plant construction in the Gulf will try and take care of the price. But in the near term, I think it's determined by the pace of Japanese restarts. That being said, I also believe all of the juniors, all uranium juniors, are going to need to refinance in the next 18 months. And any of the good ones who are willing to refinance on reasonable terms, for me that includes a warrant, I'm going to participate. The last uranium bull market, I was early. In fact, I was way early. I was so early, in fact, I was tempted to characterize myself as wrong. If you're 5 years early at a 10% cost of funds, arguably, arithmetically, you're not early, you're wrong. But the truth is that market paid me so much rent that there was no discount rate that I could have charged myself that would have made the investment uneconomic. What really tickles me about the uranium business now is that the number of companies has crashed again. It's like we forgot to learn from the last lesson. So here we make this stuff for 60 bucks a pound. It's like the oil business. We make it for 60, we sell it for 29. Because we're miners, we try to make it up on volume. We're a especially skilled lot. But the truth is, if the uranium price doesn't go up, the lights go out. It really is that simple. Even in places that can afford not to have uranium, like the United States, 15% of baseload power comes from uranium. So what happens if 15% of American baseload capacity goes away? It's called a blackout. A 3% disparity between supply and demand crashes the system. What does 15 do? This is stupid. The price has to go up, but I can't tell you when. And the other thing is that there's a lot of people around that were here for the last uranium bull market. Anybody who paid attention had so much fun that at the first hint that another bull market comes, my suspicion is that the buying interest that goes into the few remaining uranium stocks, to paraphrase my friend Doug Casey, resembles sifting Hoover Dam through a garden hose. The last market, at the beginning of the bull market, there were 5 uranium juniors, 5, that had survived a 20-year bear market. In the ensuing bull market, the worst of those companies went 22 to 1. That's the worst. Will it be the same this time? Of course not. But a little echo of that satisfies all the greed I have left. It's a tremendous number. One more question?
You were going to talk about Canada.
Was I? I was going to talk about Canada. I only insult governments where I pay tax. And I pay a lot of tax here. In truth, what Canada has going for it relative to the United States is a lack of hubris. Maybe because you're next to us and we always offend you, the Canadians don't seem to have this sense, mercifully, with one exception, who unfortunately is the PM, that you want to run the world. What you have going against you is that the road to ruin, uncharacteristically, you're ahead of us on. Canada has really decided to outpace the US in terms of aggregate indebtedness and in terms of sacrificing the balance sheet in favor of wrecking the income statement. The third problem that I see in Canada from my own point of view is if you look at what's been important with the Canadian dollar over the last 50 years, what you learn is that Canada's a petroleum economy. It really is. I mean, the one thing that Canada does really, really, really well is not auto parts. It isn't, despite what the PM says, Quebec-based EPCM companies. It's oil. And if you refuse to provide ways to get that oil to market, oil pays for equalization. The margin on oil runs Canada. And the political response to a way of thinking, evidenced by the federal Liberals, has been that Canada has declared war on itself. It's a very odd thing to watch south of the border. We would, as an example, with our Gulf Coast refineries, this is insane, with our Gulf Coast refineries, we have to burn Venezuelan crude because y'all can't sell us yours. We've had spats between the United States and Canada before, but I guarantee you that Americans would prefer to buy Canadian oil over Venezuelan oil. I mean, this is not a really provocative statement, but you don't seem to want to sell it to us. So anyway, did that deal with Canada fairly well? Okay, ladies and gentlemen, thank you very much. Thank you so much.